Welcome. Today we're working on inventory errors, how that affects net income and cost of goods sold and ending inventory and so on. Hello, my name's Jeff from Finally Learn, where I help you finally learn financial literacy, including accounting and Excel and things like that. So here let's look at LIFO, FIFO, and the differences in net income. Now, if we assume inflation, and I did a little simple example over here, we're not really going to use the numbers just as an illustration. So if we have FIFO, that stands for first in, first out. Well, if you sell the first items that cost 5 and 7 and 9, then you have a lower cost of goods sold and you have a higher ending inventory. Why would you pick the FIFO method? Well, because you want higher net income and you know it has higher income taxes, but it lets you pick the higher net income method, the FIFO method. Why would you pick the LIFO method? Well, LIFO method says the last items are the first ones you sell. So you sell the $12 one, the $10 one, so on in this case. So it leads to a higher cost of goods sold, which means lower net income and therefore lower ending inventory. And so it is a way to lower your taxes. So generally people think that when you have FIFO method, you're looking for a higher net income. And when you're looking at LIFO method, you're trying to lower your income taxes. Okay, so let's get into inventory errors. Now, we're going to use the language overstated, which means if a number is too high from what it should be, and then understated if it's too low from what it should be. So let's assume we have a problem, and all this, we just made up a number. Let's just say this is the correct column of information. So we have beginning inventory plus purchases gives us goods available, minus ending inventory gives us cost of goods sold. So this is how you calculate cost of goods sold. And we're going to think about the impact on the income statement and on cost of goods sold if we have an inventory error. So let's assume we have an inventory error of $1,500 and it's understated. $1,500 understated. That means the ending inventory right here, instead of being $2,500, it's $1,500 too low. So let's assume that for some reason we recorded it at $1,000. Well, what's the effect? Well, it means our cost of goods sold is too high. So that is going to be overstated. Cost of goods sold is overstated. So think about our effect on net income. If our cost of goods sold is higher, our effect on net income means net income is going to be lower. So what happens here? If our ending inventory is understated, our net income is going to be understated because our cost of goods sold is going to be overstated. We'll create rules here in just a second, but let's do the ending inventory if it's overstated. So here we had if it's understated, let's do one if it's overstated. All right, go back to our original numbers. Here's our original numbers. And let's assume that our ending inventory, for some reason, we made an error and it's too high by $1,000. So this is $3,500. So what that means is our cost of goods sold is going to be, instead of $6,500, it'll be $5,500. So our cost of goods sold is going to be understated. It's too low by $1,000. And it's going to be net income. If our cost of goods sold is too low, our net income is going to be too high by $1,000. By the way, up here we could put 1,500 as the exact number. We're assuming no taxes. So in the first case, our net income would be understated by 1,500. In the second case, our net income is overstated by 1,000. So our net income here has a relationship with ending inventory. So let's think about what we have. If our ending inventory, let's do the first one is overstated, like number 2 here. If our ending inventory is overstated, what's the effect on cost of goods sold? Well, it's going to be understated, and our net income will be overstated. So if our ending inventory is too high, our net income will be too high. Well, what if our ending inventory is too low, like the first example? That means our cost of goods sold is going to be too high, overstated, and our net income is going to be understated. So here's a chart you can use to think about the effect of ending inventory error on cost of goods sold and on net income. All right, so let's think about what if we continue here our ending inventory for 1 year is the beginning inventory of the next year. Okay, so let's go back and reset our problem. So let's assume that this happened right here. We still have the 2,000, 7,000, so on. And so what we said was the beginning inventory is 1,000 overstated. 1,000 overstated. So instead of being 2,000, let's say that we have an error where we mistakenly recorded it 3,000. Well, if our ending inventory is overstated by 1,000, our beginning inventory rather is overstated by 3,000, then the effect is going to go all the way down to cost of goods sold. Our availability will be too high, our ending inventory will be correct, but our cost of goods sold is going to be 7,500. So what's the effect? Our cost of goods sold is going to be overstated, and then our net income would be too low. So it's going to be understated by that original $1,000. All right, so let's think about this. If our beginning inventory is overstated, then our cost of goods sold is going to be overstated, and our net income will be understated. Because when we know our profit is going to be smaller when we have a higher cost of goods sold. So let's think about the reverse. If our beginning inventory is understated, then our cost of goods sold is going to be understated, and our net income will be overstated. Now, if we look at ending inventory and net income, they move in the same direction. If we look at beginning inventory and net income, they move in opposite directions. Okay, so let's ask a question, see if you can think through this. Let's assume JT Inc. overstated ending inventory for year 1 by $5,000. JT reported year 1 net income of $40,000, year 2 net income of $50,000. And we know those are the incorrect numbers, those are the original numbers. All right, so what is the effect of the inventory on year 1 and year 2? And we did not find the error. So let's assume we did not find the error. So what would happen is, let's think about if ending inventory is overstated. Okay, let's go back up here. Ending inventory is overstated. That means your net income is going to be overstated. Okay, so we overstated inventory by 5,000. So to make it correct, we need to take 40,000 minus the 5,000. So the effect is we overstated net income for year 1. Okay, so the effect was we reported 40, it should have been 35. Now, what about year 2? Now, think about this. Ending inventory for year 1 becomes beginning inventory for year 2. So what if in year 2 we have beginning inventory and it's overstated? Well, it's going to understate net income. So what we have is we need to take the 50,000. It was too low by 5,000. We're going to add the 5,000. So the effect on net income is we didn't overstate net income, we understated net income when we reported the 50,000. So let's think about what we know here, the total income. So the total income, net income for the originally reported is 90,000, and the total, if we correct it, it's 90,000. So what happens is this is inventory can self-correct, or the error washes out. So ending inventory makes year 1, and incorrect ending inventory makes year 1 incorrect, but it makes year 2 beginning inventory incorrect. So it self-corrects and it washes out. So if we discover this after the end of year 2, then we don't do anything because the total net income is correct. Year 1 should have been 35, year 2 should have been 55. It was 40 and 50, a total of 90. So in 2 years, an inventory error washes out. All right, thanks for watching. We'll see you on the next video.